damage control, drawdown, leverage, what is going on with the market. I think this is a good time to remind people that running a hedge fund implies, first and foremost, execution against adverse effects. This is one of the main tasks of a hedge fund manager. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And this is exactly how it feels like. This is how it feels like. It is very difficult to sustain drawdowns. It is difficult to be exposed to external events that you can't control. This is part of the life of a hedge fund manager. We're exactly in a situation like that. Since the beginning of the year, the fund is now down 16.3%. The market's down 8%. We're underperforming by 8.3%. So this is, in a nutshell, what's going on. This is the Not Even Wrong podcast. It's January 23rd, 2022. This is Krimdelko. Like I said, for the year, we're down 16.3. The market's down 8. We're underperforming by 8.3%. And this episode is all about what's going on in the market. What is the downside we're envisioning? How do we manage our fund? How do we see the situation evolving? And what are the risks? And how do we manage those risks? Because this is really what it's all about. You know, very often hedge fund managers, they like to talk about ideas. They like to be creative. People like Hugh Henry talk about paradoxical investing and all these types of things. And they're all fine. All of these things have merit. But when the rubber meets the road, it's about cash. It's about how much money do you have in the bank and do you survive? Because that's how you're measured. This is like a sports team that in the end, you can talk about offense as much as you want. If you concede too many goals, if you concede too many points, you're going to lose. So that's what this is all about. It's about defense. It's about understanding the risks. It's about trying not to die or making a huge effort not to die, because this is like evolution, right? If you can have the best strategies in the world, if you don't sustain drawdowns, if you don't sustain massive drawdowns, if you crumble under the pressure of external events, then you can't survive. And this is this applies as much to your actual P&L as it also applies to your investors. And we at Orange Capital Partners haven't done a great job. We've lost many investors in the past because of drawdowns that we had. Most of our drawdowns were because of actually unforced errors. They weren't because, or let me say it that way. We most of the time, I think if I go back in the 13 plus years that we've been around, we've had some situations where probably we lost investors because of macro situations, because people were scared. But a lot of times, we lost investors because of unforced errors. We invested in GoPro, we invested in Twitter. Those were mistakes, and we lost a lot of money, and that was not necessary. We are now in a situation where we have massive drawdowns, and in our opinion, it is absolutely macro driven. We have what's called a rotation away from growth stocks into value stocks. We have a sell-off in stocks like Tesla. Also, our biotech index has suffered a lot. So what I want to do in this episode is talk a little bit about why this is happening and what is our downside. I think in situations like that, you have to assess, okay, what is the worst case scenario that you expect? First of all, what is happening? Again, there's a rotation. Money is flowing from here to there. These things are happening. We can argue as much as we want about why and is it warranted and blah, blah, blah. It's completely irrelevant because it's happening and it's hurting our P&L. So now let's talk about what do we expect? How far can this go? What are the ramifications of this? And let's talk about Tesla, which is our largest position. We believe that Tesla can reach probably something around $600 as a full downside, which is another 30%. This is based on the forward earnings of Tesla that we believe are going to be sort of in the range of maybe $8 to $10, and something of 50 times those earnings is the most downside we expect. Now, that will be, of course, about $500, but we believe that downside will not be reached. This is based on very sort of back of the envelope valuations. But when it comes to situations like that, when it comes to the management of a fund, you have to have these types of calculations because they give you a sense for how bad it can be. They give you a sense for how far this can go. And they also give you a sense for what kind of leverage you're going to have, because this is key. Don't forget, you have an exposure through leverage. We have about, right now, as we speak, about 18% leverage in the fund. And it can go even further. It can go, if we're right, and this whole thing pans out the way, so we are down another 30% in the fund. Let's say let's add another 5% to the biotech index, so 35% from now, we would have leverage in the 30 to 40%, which is much, much higher than what we expect to have, much higher than what we want to run the fund at. But crucially, it is something that we can stomach. And don't forget, this is the absolute downside we expect. So we expect to be able to stomach this without margin calls. Now, as far as our investors are concerned, of course, that's a different story. Will they be able to sustain this type of pressure? Will they be able to manage the fear? This is our job to tell them exactly what we're telling you. This podcast is also meant for them. Look, because here's the thing. We believe that the fundamentals of the business of Tesla and our biotech stocks, which are our main investment, let's put Bitcoin aside for a second, even there, but particularly Tesla. Let's look at the fundamentals of Tesla. Let's assume we have a recession. The recession that we're going to have in the next 6 months is the recession we should have had after COVID broke out. We postponed it by 2 years by printing money and giving persuasion and all that stuff, people not being forced to pay rent. All these types of things accumulated in the economy continuing to tick without production. And that created inflation. And now we're having a recession, which is the logical, which is logically what happens after a situation. Like whenever we have inflation, a recession follows. And what we're going to have is a recession. So what this is going to do to Tesla is the demand is not going to be hurt too much, but the production is going to be facilitated a lot. So we believe that actually Tesla will be able to come out even stronger out of this recession. The pricing they have to lower the prices a bit. The margins will be much better because the cost will be even better. And we will have probably, like I said, $8 to $10 in earnings. So the most downside we believe is going to be around $600. And we believe that the stock can finish the year around $1,200. If we didn't have this recession, the stock should be more like $1,500 to $1,800. So with the recession, we take a 30-40% haircut of that. So $1,200. This is what we expect for the end of the year for the market, given the information we have today in terms of Tesla. As far as biotech is concerned, what we believe there, the strength in biotech will come from M&A, because if this continues, I'll just give you 2 examples. One is Intellia. The stock is now at the same level as it was before the great news from last June, when they showed proof of concept through their in vivo therapies in one of the illnesses that they're treating with CRISPR. So the stock is, or even lower now than prior to this great news. This is, of course, this makes no sense, in a sense that you should have at least a little bit more upside in the stock based on good news. So that shows you that there's some sort of undervaluation going on. And this undervaluation will be recognized by M&A, if not by the market. Another example is Twist Bioscience. Twist Bioscience reached at the peak $20 billion. Now it's less than $3 billion. A company that has a lot of disruptive forces playing for itself. Again, we believe that the company will be approached by other companies to be bought, and they will probably refuse to sell. And in the end, they will sell at the high, a $20 billion market cap. They might not get that bid, so then the market has to wait until they get to maybe 10 billion, and then they can get a 100% premium. Either way, we believe that there is a massive recovery going to happen in those stocks. We believe that our CRISPR index can finish the year at least flat, if not up. So we believe that we have another 5 to 10% contribution to the fund from there. So if we add this all up, we can have a contribution from Tesla to about 15% to the fund, and another 5 to 10%, let's call it 7% to the biotech index. So we believe that we can finish the year sort of in the low to mid 20s in terms of performance. This is the expectation we have today, given the information, given the macro environment, given all the expectations. Now, to finish the episode, again, I want to give people a sense for what it feels like to run a hedge fund. I think the first thing is fear is fine, but what are you going to do with this fear? This is, Mike Tyson. And I think it applies to this situation. What are you going to do with this fear? Are you going to freak out? Are you going to sell, or are you going to reassess your risk, reassess your upside, your downside? Like I said, our downside is now at 30%, and then we can finish the year up 20 for the year. So that means that we can go down another 30, and then we can basically double. This is absolutely in the cards, given the environment. Of course, there's a lot of caveats here. I made assumptions that the fundamental businesses of all these companies will continue to do well. And that is an assumption that warrants a whole nother episode. Why do we expect that? Why do we think that a company like Tesla can keep delivering? Well, the reason is because they have demand and they have the ability to produce, and they're bringing two factories online. So combined, the fundamental business should actually get better through the recession. And this is exactly also what we expect in the biotech index. Thank you.